Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room for Friday, March 12th. Let's take a look at the markets right away here. We have the gold market trading last at 1703.5. It's down about $19 here. And if we let me make some room here. Let's take a look here to see where we are here today in terms of the VCPMI indicators here for the day. On the left of the chart, you see the numbers here for today that are indicating basically the buy one level is 1713, the buy two level is 1704. The average price for today is 1725. And what we saw here yesterday was a completion of this pattern into the distribution of supply area that the VCPMI identifies as a high probability area where you potentially can find sellers or supply come into the market. When I talk about supply, basically I talk about sellers, and it's irrelevant as to what kind of supply it is. And sometimes it's overwhelming supply, paper supply, essentially by the commercials. But regardless of who is selling up here, the algorithm tells you that this is a high probability area where you are going to find that kind of activity, that kind of energy into the market. Now, once it completes the pattern, it reverted right back down and activated a short trigger. When the market activates a short trigger from the extreme above the mean, and most of the time, I would say more than 80% of the time, the market reverts from the sell one level. And the initial target is the average price. So it went, it activated a short. Let me fix this here so we can see pretty much when the signal was activated. At 1:30 a.m. on a close below 1733, 1734, the close was 1733.10. It activated a short trigger. This short trigger automatically activates the average below and the extreme levels below that average price. And what you see here is the market took a little bit before it came down. It tested this level several times. It came down, found some support, went back up, tested it again, got more sellers coming up here. By that time, it was about 5 a.m. And you saw the energy resolve itself unfolding into the mean. And this is what the AI tells you, that when you're trading around the average price, that you go neutral. The average price is 50-50 standard deviation. So if you trade that average price, expect to get chopped up. Back and forth. It's a 50-50 standard deviation. And so you can see here, it chopped around it with a bearish bias. And it finally unfolded into the energy of the market at 5:45 p.m. on 3/11. This identified the bearish price trend momentum. And when it activates the signal here, it automatically activates the levels below, the extreme below the average. In this case, 1713 and 1704. And so you see the market following that momentum, testing the first level here of 1713, testing it again at about 10 p.m. and trading below the buy one and buy two level. Now, this is when the AI basically converts, conventional pivot points, so to speak, in terms of probabilities. And it ignites the color blue that essentially begins to alert you that you are now at the extreme below the mean, where you potentially are going to see buyers come into the market. So automatically, when I have a picture of where this level is, I am aware not to sell into it, because if you're looking at the probabilities, when it activates the buy one level, buy two level, you're looking at 95% probability to the mean, which is 50%. So it'd be a 59% relative implied volatility to the mean. That usually means that is the extreme, mathematically speaking, for this price range for this session. We're talking about day trading. And so the AI tells you, do not sell into below B1 or B2, even though the price may come down, even because you still have a 5 or 10% probability factor left over that the market can test those levels. And sure enough, of course, it comes down, tests those levels. There's no buyers yet that show up until it comes down below the buy two level. And it neutralizes the daily signal. When the price comes down below B2, it neutralizes the daily program, the daily system, and it integrates the daily pivot points with the weekly signals. Then we begin to look at the longer term or the intermediate term signals. And so what we see here is that the market has come down to the extreme level of B1, B2, under B2, but it's trading roughly around that B2 level, which is a 95 probability right now that the market, if we activate a trigger, has the probability that it would unfold and revert back to the mean. This is not a guarantee. It's a probability model that identifies the extreme levels of the supply and demand for this trading session. So we seem to have come down to a high, again, probability area where we could identify buyers coming to the market. Now, the levels, when the price of the daily breaks the B2 level, then what we have underneath is basically the buy one level all the way down to 1668. Which is active. But right underneath this B2 level, you have the golden ratio once again of 1685, which is the Fibonacci retracement golden ratio of 61.8% retracement from the high that we made in August of 2089 to the previous low of 1450. That gives us a 61.8% retracement from that rally, which still does not break the bullish pattern established from the previous trend. The market simply is reverting back, testing the buying interest or demand, or seeing what kind of strong hands or weak hands, the buying is occurring down here. Now, looking at the relationship between the daily and the weekly, obviously in the gold market is at an extremely oversold condition, and the probabilities indicate that the path of least resistance, if we get the trigger point, if we close above 1704, that's going to be the trigger point for the gold market. So keep an eye on that for the time being. Let me go to silver here. $25.65 trading last, down 54. The low that we made here last week on Friday was 24.84, and this brought us all the way up to about 26.50. So you're getting almost $2, $1 or $2 moves in the market here, like it was really nothing in the silver market in particular. So the volatility obviously is increasing tremendously. In looking at the silver here, it has activated a buy trigger here on this bar. This huge bar is the confirmation that I talked about a bit earlier, that what we're looking for is for this kind of buying that overtakes all the previous selling that takes place. It pretty much took out all that supply. Now, mathematically speaking, or the signal basically is that the market came down to the 25.55, which is the buy 2 level. It's 50.95 relative implied volatility to the mean, activated a buy trigger, and it's been reverting from here all through here. Now, the AI from here, it tells you that the majority of the time, if you get a signal from the B2 level, you may want to hold it until the end of the day if you can afford to handle that risk. It's all about risk, what is comfortable for you. The initial trade, as it was initiated, I recommend my traders in the room to use their personal profile, number one, to have a dollar maximum catastrophe stop, first of all. And that, is relative to your profile. But I myself have a maximum, a dollar stop. I carry $1,000 maximum stop per contract, regardless of the signal, and so that if it negates, if it's negated, obviously, I don't want to, from a preservation of capital point of view, lose a certain amount of money, no matter what, no matter how good a situation looks to be. So the first thing is that you want to carry a maximum catastrophe stop underneath. And we don't recommend traders to use straight stops because you're going to get stopped out constantly. And so what we have is two other choices of stops, in that depending upon, again, how or what kind of a trader that you are, if you're conservative or aggressive. So for conservative traders, If the market closes below the level that initiates the trigger point, then you can get, you can get stopped out at the market. And the other basically is, as I said to you, when you're looking at the probability factor from that B2 level to be 95% probability that as the day progresses, more than likely the price will be inclined to revert back up to that mean of 26.21. So you have those three levels that you can manage your position from here. Now, depending upon the multiples that you have, obviously, if you have one contract, you can only do so much when you're trading in the futures contracts, which, by the way, is one of the reasons why I trade the shares, because if I buy 100 shares, even though it might be a small amount, I can still sell, parcels of those shares, so to speak, if I want to scale in or out of a position. So you usually have a little more flexibility when you're doing shares. But if when you're trading in the futures here, if you are a one multiple contract, then you can choose any of those three stops, and the targets are automatically the levels above. So in this case, if it went long from this level here, the initial first target would be the weekly average of 25.77, and depending upon where you went long in here, this would be the first target. That would be the weekly, activating a neutral signal from this bearish trend momentum that was activated. And if it closes above it, actually, it would bring in the bullish price trend momentum on the weekly. But the daily target would be 25.87. So that would be your first target. And obviously, depending upon what it does up there, if it closes above 25.87, then it activates the final target for the day, which is 26.21. So that's a considerable move. If it does get up there, obviously, it would put the market into a positive territory, and a very strong signal would be activated. So we are also in silver at an extreme level below the mean with an oversold condition. It has activated a daily buy trigger from B2 level. Let's take a look at Gbtc. We recommended our traders yesterday to take some profits if you were long on Gbtc. We love this instrument to trade actively, as opposed to converting it to a currency, because that is certainly an argument that we can discuss or have a discussion about. That it's not a currency. It's a virtual asset being used basically in the virtual economy that we've kind of really moved into here since last March of last year. But it's a tradable asset. We trade it. We recommend to trade the market at this point, particularly when you're looking at $50,700. It's an astonishing, appreciation of this virtual asset. So let's just keep an eye on this stuff, and I would love to see the market revert, particularly back down into into that 32 area here. We got obviously some numbers coming out this weekend here, and they'll be published over the weekend for our trader subscribers in the private trading room, and be able to have access prospectively here to the information that we have as we come into next week. Pretty quiet morning, as I pointed out here. So let's just watch the market here a little bit and see how it does at these levels here, what kind of buying or selling we see here. We came down here to a low of 1676.70 here on the 9th, and we stabbed almost into the weekly buy one level of 1668, but you can see here the weekly numbers coincided with a golden ratio Fibonacci number of 1685, and this is a pretty significant retracement here, as we have retraced back, or we have given back 61.8% retracement of this rally here that we saw from March of last year. And one of the things that if I may get into some of the fundamentals here a little bit, in this anomaly in the market here, obviously, since the high was made of 2089, and it seems that even though we saw a new high in gold of 2089, it feels like the price really did not appreciate to its natural mean based upon the transformation that we had here back in March, that I believe the gold market became a currency again, as opposed to the US dollar fiat becoming a commodity. The US dollar fiat currency, the US dollar petrodollar, reverted into a commodity, and the price of gold shot up of over $600. Now, is that the only thing that we're going to see in this market? I don't think so. I don't think that we have seen yet the true price discovery of the true value of gold and silver. Now, silver in particular. So this anomaly here has frustrated a lot of traders that were not only anticipating the gold market to explode above 3,000, 5,000, some crazy numbers were thrown out there. And the market discounted all of that damage potentially, and we began to see sellers and pressure, central bank selling consistently all the way through this descending channel. The Commitment of Traders report that is put out every week indicates the players in the market, commercials, hedgers, or small traders, or in the other category. And you can get an idea more or less of the amount of selling pressure that occurred since here, when nothing really changed fundamentally. In fact, if we take a look at where we are right now, with the new Biden administration approving the $1.9 trillion stimulus package here, it is a staggering amount of money that has been printed since March of last year alone. And if we include, I think if we go back to September 19th, when the Feds announced repos in the credit markets, we began to see a tremendous amount of money being pumped into the system, because the swap. So they anticipated a bigger damage than what originally it appeared to be, because in fact, we really yet don't know the totality of the damage that was done. But what's really interesting is that we have crude oil trading at $67, $65, $66 a barrel, when just last March it went negative. It went negative $37 a barrel at the bottom of the barrel, and now we're looking at a 67.98 high that was made here this week. And this is counterintuitive of what crude oil pretty much should have done on the face of this disruption of supply, demand. This pandemic disrupted basically all the markets. But I'm coming back here and I'm looking at crude oil, $65 a barrel. I'm looking at soybeans. We got up to $14.60 a bushel. Wheat, $6.93 a bushel. Corn got up to $5.74 a bushel. It's very hard for me to hear the Feds announce that there's no inflation. That inflation is running at below 2%. Well, if you take out these components of the economy, which are two of the major components, energy and food, you're obviously going to skew the bottom line to get what you're looking for. And that's the level of inflation that the government seems to be pontificating we're in. I personally think that inflation is running at much higher levels than what the government figures indicate. In fact, Shadow Stats is showing an inflation rate running, shadowstats.com is showing inflation rate running at about 8 to 10%. If you include these components. And it's a little more realistic because they follow the the old formula that was used in the 70s. And we're having some difficulty here. Are we ready to go? I'm sorry, we had a little bit of a problem here. As I was saying, that in the 70s, the inflation level went through the roof right after Nixon lifted the gold standard of the US dollar, and the US dollar became a fiat currency. And in 1981, obviously, we saw interest rates at 15%, and the price of gold went up to $800 an ounce. So, prior to Nixon, gold was at $35 an ounce. And so the interpretation here that I'm hearing about interest rates is bearish for the price of gold, I think is misinterpreted, because what in fact the 10-year note is anticipating is that we are moving into an inflationary environment, and the first signal that we see, basically, or the first sign, usually is interest rates. And the 10-year note right now is trading at 163.50. It's making a new high. This is a new high for the 10-year note. And I think this is a real critical level to see how the metal markets react to this. Is this going to be a pattern now where interest rates are going to be running up, going up? When you really think about it, it probably will be the worst thing for the Biden administration on the face of all the stimulus that's being printed, which increases the debt. And already some pundits out there are forecasting that the debt during the Biden administration is going to exceed $70 trillion, ladies and gentlemen. That is more than double the debt that we're carrying right now. Just think about this. These are staggering numbers, and if in fact that is true, what do you think is going to happen to the US dollar? It doesn't matter how much you raise rates, the US dollar will collapse on the face of all of this stimulus that will bring a high level of inflation and potentially move into hyperinflation. The thing I'm seeing here is that things are being accelerated quite a bit. And the changes that are taking place are incredibly rapid changes that sometimes it would take years, if not a lifetime, to change. You're looking at a history in the making here. You're looking at uncharted waters. And I think this situation is only building a tremendous argument why I believe you got to be bullish in the gold and in the silver market. Particularly in silver, as we erode the value of the US dollar. We go back and see what real money is. And what people are going to see when it all comes down to it is that real money is going back to old principles. And those principles basically accept gold and silver for thousands of years as money, as a form of exchange, particularly when you have a collapse in the monetary system, as we, I believe, are witnessing in terms of a transformation into a new paradigm, a transformation into a new economic system. The old system collapsed, ladies and gentlemen, and we have to let it go. The old physical system, as we knew, collapsed as you know, this last year, 2020, as a consequence of the pandemic. And we awoke to an incredible virtual market where everything now pretty much is done virtually. It, again, it's changed completely the way that we knew things and how we did things, work socially. And it's an exciting time. It's an exciting time, particularly for the millennials, for the young, the young crowd, so to speak, that are beginning to see the reality of what this means. And if you are awakened to what's happening here to this country, what's happening to the US dollar, and you take a look at the results, basically, or the consequences of these monetary policies that are, no question in my mind, inflationary as we move forward. Some of the numbers that we got from the Eurozone this morning indicated also that they are buying, more bonds. They're continuing to buy their own bonds. They are continuing to supply stimulus to the market. And I think, this is where we headed. The unemployment numbers came out this morning, which gave, I believe, the 10-year note the room to move up in rates. They were down more than expected. I think it was about 712,000 as opposed to 760,000 expected. But you're coming off the bottom of the barrel, so any small change is going to be a positive change. But there's still millions of people unemployed, and we're dealing with a real delicate system still as we go back or try to go back into the economy. And I think the sooner that we go back into the economy, the better, because underneath the fundamentals are just collapsing. Just think about this. There's a disparity of wealth that happened here last year, unlike I have ever seen in these markets as long as I've been around. Certainly the lower middle class or the middle class, went lower, and there's a great deal of people out there that are in desperate, dire need of assistance. And so hopefully this stimulus will give them the assistance that they need. But as far as thinking that, we're going to go back into the economy, we're going to, go back to some kind of normality as we knew it, I think is a far-fetched idea. I think we have to recalibrate and adjust to all of these new experiences that we are going to be facing with, and challenges still that we're going to be facing with, and adjust to the new paradigm. But at the same time, this whole thing has created an incredible opportunity. Again, when you talk about where we're moving in terms of inflation, which in fact it is a real discussion right now, the potential for this gold mining shares, for example, this assets related to gold are on a fire sale. And you want to be careful in terms of, choosing individual stocks if you go into the gold market sector. But I choose to trade the GDX, which is the VanEck Vectors precious metal ETF, and it gives me the coverage that I want to have as an index, so to speak, as opposed to trading some individual stocks. And I do have some preferences individually, but Most of the trading that I do in following the VCPMI is done on the stocks, the indexes. I do look at Nugget, which is a 2-to-1 ETN. It's a very aggressive ETN that is a 2-to-1 leverage to the underlying index, and it's an exciting instrument to also to trade when particularly you want to manage risk, margin risk. So you have this situation that I believe has created an incredible opportunity in gold mining shares, which is why I'm suggesting my traders, my subscribers, to take a look, at this area, because the gold market will respond to everything that's going on economically. It's a leading economic indicator. Although some people think it's a relic, an old relic, and it put it behind, go to Bitcoin. I think when all is said and done and the music stops, you're going to find that gold and silver are the supporting factor underneath the whole system. And in fact, I believe that in order to bring back the confidence to the economic system on a global scale, gold and silver have to be part of that system. Otherwise, we're talking about, fiat virtual currencies, fiat currencies that are protected by nothing except the faith and trustworthiness of the governments that issue them. Well, you see where we are, and what they've done over the past, certainly 50 years, and that should give you the answer to that, which is probably the motivation for creating a lot of these alternative currencies. Everybody is seeing that the dollar is doomed, that the particularly with this kind of stimulus coming into the market, it does not bode well for the US dollar. You can see the signal here activated a buy trigger under close of 1705. Again, if you are a conservative trader, you can put your stop on a close below 1704. Or you can choose to use the two other stops recommended, depending upon your profile. So this, as you see, gives me personally a great deal of time to coach and teach those that are serious about making a difference in the bottom line of your portfolio, and use this as a GPS for your trading, for your driving when you're trading. I don't listen to the chatter. Because by the time the price comes down to these levels here, already all of that sentiment has been factored into the price. And coming down to that B2 level, that's the completion of that energy, is what the algorithm tells you. At 1704, if we, on this close here, it completed that pattern and it activated a bullish trigger. So you have your entry point, you have your protective level, and you have your target in place. Very defined structure. So one thing I want to point out if you take a look at the weekly average of 1713, it matches perfectly the buy one level of 1713. And I know what my traders probably are saying in the trading room is, yeah, that's a harmonic alignment. Yes, it is. Yes, that is in a harmonic alignment. And that is a very strong probability level, a pivot level that indicates there is at the 1713, the synergy, the harmonic alignment of the daily and the weekly, the daily buy one level and the weekly average price. Therefore, if it closes above 1713, you're getting a daily buy trigger from 1713 supported by a weekly bullish price trend momentum. And automatically, the 1725 level is activated on the daily target, and the weekly target activates the 1743 level. So the market will do what it's going to do. And, you can manage the trade according to your profile. But what you see here is what the AI tells you, that you don't go short below B2. You wait until the market closes above it, activates a short trigger, and using the 15-minute bar is where you judge your entry and exit points. One of the things I want to do here is I want to show you shadow stats, consumer inflation official versus shadow stats, 1990 base alternate count. I think we're looking at a big difference between the official CPI, which is under 2%, which is the red line, and the 1990 based SGS program or indicator. And you can see the inflation level is running double what they seem to be indicating, at least. The CPI chart on the homepage reflects our estimate of inflation for today as if it were calculated the same way it was in 1990. The CPI on the alternate data series tab reflects the CPI as if it were calculated using the methodologies in place in 1990. In general terms, methodological shifts in government reporting have depressed reported inflation, moving the concept of the CPI away from being a measure of the cost of living needed to maintain a constant standard of living. So I think when you take a look at grain prices, when you take a look at energy prices, obviously you get a different picture in terms of where we are. And so I think, to me, it is more realistic to include food and energy, obviously, when we're particularly making this tremendous record highs in these markets. And as we move into the later part of this year, we potentially can be running into supply problems. And that, I believe, could accelerate the inflation, the price inflation that we haven't seen. What we have seen here is asset inflation reflected in the real estate markets, reflected in the stock markets, reflected in virtual currencies, and now it's being reflected in virtual art. I believe that there was a virtual work of art that was sold for $62 million. This is the first time. That's where inflation has gone. These are a series of codes, numbers. Virtual art is nothing but a series of codes. And somebody was willing to get rid of fiat currency, which is $62 million worth of fiat currency, and convert it to a virtual asset. This whole new virtual economy now is beginning to create assets within that context. Bitcoin is becoming a currency of this virtual economy. And within that economy, we're developing other ideas, other products. It's another world, and it's offering amazing opportunities for those that are creative. So we seem to have separated into two economies. The old economy is dealing with all of this debt, all of this economic pressure. And now we're dealing with this whole new virtual economy that has no debt so far, and it's growing on its own. So is it going to be that we're going to move totally into a virtual economy? Or are we going to have a hybrid economy, a combination of both? Which is what I believe needs to happen. Because you just can't eliminate the old economy and erase it off the map. It's unrealistic, I believe, to think that you could do that. It creates all sorts of repercussions. And so, but the fact that this whole new economy is being created as the market demands that this economy is explored, allowed to be created. But my feeling is that regardless of where it goes, it is still part of the system. It's not completely independent of the grid. Because I think one of the major things is that most people fail to realize is that everything virtually, even Bitcoin coins, virtual coins, are run by electricity. That is the main ingredient behind all of this. Virtual currencies, Bitcoin. So electricity is part of the system. It's not in, unless you create your own grid and you produce your own electricity and you run things independently of the grid, which I believe people seem to be starting to do. They want to leave this system completely because they know the system collapsed. It failed them. So we're recalibrating, and in that process, obviously, it's a great opportunity. Thank you, everybody. I think I'm running out of time. We'll talk to you soon next time. Be well. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.